Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. There's plenty of negativity in the market right now. There's a real risk of recession in the US and in Europe as interest rates rise to combat inflation. But what would this actually look like? And what would it mean for investors? Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management. He's written an article about the three scenarios that could kickstart a new bull market. Remember, this is general information only, and you should get professional advice before making any investment decision. Roger Montgomery, welcome back to Fear and Greed.
It's great to be with you guys. Thanks for having me on the program.
Let's go through the three scenarios that you've outlined. The first one is a serious recession. What would it look like and how likely is it?
Well, I think we have to just take a quick step back and I'll definitely answer that question. The premise is that at some point, there will be a bull market. Yep. The question then is, from what level does that bull market begin? Is it where we are now or is it a lower level? So the serious recession question would suggest that if this scenario occurs, it would suggest that the third leg lower, the second leg lower of this bear market falls to a much lower level than where we are now. And so that scenario, essentially what happens is that the US economy remains resilient to rate rises, to the rate rises we've seen so far from the US Federal Reserve. Wage and price inflation continue to climb. And even though the Fed is tightening, we're still getting bad numbers. Now, this week we saw core inflation at its highest level. So this is a scenario that's plausible. Then the Fed is obviously forced to tighten by more and for longer than the market currently expects it. And let's remember that big moves in the market occur when the unexpected happens, not when the expected happens. So at the moment, everyone knows there's a possibility of recession next year. Everyone knows that supply chain bottlenecks are starting to ease a little bit. Everyone knows that inflation is an issue. They're not unknown, and so the market doesn't react in a significant way to any sort of reinforcement of those things. It's the surprises that causes the market to move in terms of magnitude much more than what everyone else might expect. And so in the serious recession scenario, the Fed's forced to tighten by more than the market expects, and the market reacts negatively to that. So, for example, the Fed's forced to lift the overnight cash rates to, say, 5% and keep rates there through next year. Then, this final phase of the bear market that we're in at the moment, that will continue. So the rally that we've seen overnight, peters out or reverses quite sharply.
And that's the hard landing scenario?
Yeah, I think you could call it that. But usually when we talk about hard landings, we're not referring to the market, we're referring to the economy. So presumably there would be a hard landing in the economy, but that would be after the hard landing in the market.
Okay. And so if that's the case, timing is everything, obviously.
Yes.
But what sort of stocks are you looking at? What types of companies are you looking at in that scenario right now?
We don't change what we're doing. We're bottom up investors. Our small cap team, our large cap and all cap teams, and our global friends at Poland Capital. They just go about doing their bottom up research, finding good quality businesses that are outstanding in their particular sectors. They may make some tactical, particularly in our small caps, they may make some tactical decisions about which sectors of the economy are faring worse or better. But otherwise, we're trying to make money from really high quality businesses with great management teams executing on their business plans, and where positive change is occurring in a business that's likely to close the gap between price and value. That's what we're aiming, to invest in and have higher weighted positions in.
Stay with me, Roger. We'll be back in a minute. My guest this morning is Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. So let's go to the moderate recession scenario. We just talked about a harder landing, for want of a better term. The moderate recession, explain that one.
Yeah, so this is what everyone knows is they call it the lag effect. So only a few weeks ago, we saw the Reserve Bank of Australia surprise economists by raising interest rates by only 25 basis points. So the thesis behind that is that the RBA wants to see what impact the rate rises to date are going to have on the economy, because there is a known lag between raising rates and investor behaviour or consumer behaviour, or even business behaviour. So waiting for those lag effects to occur is sensible. And the moderate recession scenario basically says that initially, right now, as we're experiencing, the economy, like in the first scenario, remains resilient. But then you start to see some evidence of a slowdown. You start to see some evidence of US central bank and Australia's central bank intentions to slow the economy, dampen demand, particularly amongst consumers. You see that starting to occur. So inflation then moderates, and we're already seeing some evidence of the leading indicators of inflation moderating. So, for example, where inflation was inspired by supply chain bottlenecks, we're seeing days delivered, backlog of orders, they're falling. We're seeing inventory starting to rise. And in fact, for some Australian retailers, we think there'll be quite some heavy discounting between now and Christmas, because they've bought a lot of stock just at the time that consumers are starting to slow down. So that you see that inflation start to moderate, unemployment starts to tick up again, and then disinflation gains momentum. Now, what we know historically, you go all the way back to the 1970s, and you know that if you're getting moderate levels of economic growth, and disinflation, then that would be that's very good for innovative growth companies. Historically, growth companies do well when you've got a little bit of economic growth and disinflation. Now, to be clear, disinflation is not deflation. It's not declining prices. It's just a slower rate of increasing prices. So think consecutively lower rates of inflation. And then in that scenario, then you'd get the US Federal Reserve pausing sooner and then reversing course sooner. And so the market would bottom at a higher level than the first scenario I gave you, the hard landing scenario.
Okay, so we'll get on to the third scenario, which is a soft landing in a moment. But what you've just described, it seems to me there's increasing market commentary about that type of scenario, I suspect.
Yeah, and so the market could become enthused about that scenario playing out. Then the market rallies, obviously. But then we go back to the comments that I made earlier, and if the market is disappointed or surprised because it's not quite turning out the way that the market's expecting or investors are expecting, or it takes longer, then there'll be bumps along that road.
Yeah. Okay. So the third scenario, soft landing, that's kind of presumably what central banks want to engineer, if possible.
Yeah, that's as I said in my article, that's the not so secret hope of central bankers. The inflation drops really quickly. In unemployment, a steeper rise is avoided because that gap between job vacancies and the unemployed starts to ease gently. And then under that scenario, the Fed just pauses. It says, you know what, things are going much better than we anticipated. We said we're going to have to keep raising rates. We're not going to have to, and then you can imagine the champagne's flowing at that point. Yep. And then, in fact, rates might, start to head lower again at some point in the future, or the market gets a head of steam about it, believing that that's going to be the scenario. So you get disinflation, positive growth, a low rate of growth, of course, and then the market is off to the races.
So the $64 question, Roger, as we sit here on Monday, the 17th of October, having seen those 40-year highs for the inflation figures late last week in the US, which scenario is the most likely?
Yeah, well, when you say most likely, none of them are 100%. I wouldn't give them any of them 100% chance of occurring. But I actually think the moderate scenario is currently the most likely scenario. So, we're already seeing bottlenecks easing. Employment's not going to get stronger from here. So unemployment may start to rise gently.
Which, of course, isn't a bad thing.
No, correct. And the other thing that we haven't talked about that could happen, we saw the headlines in the papers this week, and you probably talked about it on the program, and that is that there's been a speeding up of visa application approvals. Now, we've talked about this before, but one of the relief valves is getting more people migrating to Australia so that we can get the pressure on salaries, particularly in hospitality and retail and elsewhere, we can get that pressure relieved, and that's a good thing. So that's happening. So, there are some signs that moderate recession scenario is the scenario that's most likely at the moment.
Roger, thank you for talking to Fear and Greed.
Always a pleasure.
That was Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.